As we noted in our July video, the U.S. stock market surged in the first half of the year thanks to easing inflation data and thanks to a U.S. economy that has remained resilient in the face of higher interest rates. However, we also noted back in July that the market run was probably a little too optimistic as the fight against inflation remains ongoing. And sure enough, since late July, the S&P 500 is down about 5.5% and the NASDAQ is down about 6%. And it's not a coincidence that roughly over the same time frame, the 10-year U.S. Treasury yield, which is highly influenced by interest rate expectations, has surged 24% and is now at a 16-year high. So what's going on? Well, the U.S. economy continues to grow despite elevated interest rates, and inflation, while generally trending downward, remains an issue and is still nearly double where it was before the pandemic. This has forced the Fed and investors to gradually revise their 2024 interest rate projections higher, and investors are now grappling with a higher rates for longer scenario when just a few months ago the expectation was that interest rates would soon be heading lower. So, what does this mean, and what can we expect moving forward? Well, we may see more choppy trading leading up to the Fed's next meeting in November, but interest rates should soon peak, which would give relief and clarity to investors. And lastly, as always, having a financial plan and sticking to it is the key to properly assessing how to handle the ups and downs of the market. I always feel that the end of the year or the beginning of the year mark good times to review the year that was and reassess your goals, your objectives, your time horizon, and your tolerance for risk.